Phantom shares or the shadow shares, it is gaining popularity in the recent times. The instrument has been derived from SAR or stock appreciation rights. It is a method to give incentive to your trusted and long-term and efficient employees. The term SAR was earlier there, it is also still there. This is linked to the performance of your employees and how your company is growing. Phantom share is a share which is never issued, but it is linked to the growth of the company and the value of the equity shares. In the Companies Act, we have studied about the stock option plan, SOP, ESOP, everything which is given to the employees to make them a part of, or to make them feel with the in line with the company, so that they feel that they are part of the company. But this is our concept is slightly different. The shares are never issued in phantom shares. A number of shares are given to the employees. This is hidden shares or shadow shares, and that it is said that it would be redeemed and the value would be given to them at a certain point of time. For example, to an employee 100 shares are given at a point of time. That shares is never allotted. They are given a letter stating that you are entitled to phantom shares of 100 number of phantom shares having this much value as on date, and after 10 years or after 5 years down the line, you will get an amount for 100 shares which is there at that time. It is linked to the valuation of share of the company at that time. So in case the company share price is rupees 1000 per share today, and after 10 years suppose it is 10,000, so they will get the amount 10,000 multiplied the number of shares of phantom held by them. So this is a performance linked bonus, you can say, or an perquisite, which is given to the employee, and they also get the benefit of growth of the company which is there, which due to their efforts. So the employee gets incentivized. The company is also happy that they don't have to do all the secretarial compliances for allotment of shares, increasing of the authorized share capital, getting the approval of the shareholders. These are not required, and this is only an accounting entry process which is there, and it is to be done, and letter is issued to the concerned employee, and a valuation is given at the end of that period when it is granted and it is there. So this is the whole process of phantom shares. Now coming to the tax implications. At the time of issue there is no tax implications. When the shares are given, means when the value of the shares are given to the employee, it is treated as a perquisite, and it is taxed under the head income from salaries. So this is equivalent to a perquisites. At that time the employees are required to give the tax as per their tax return and tax calculation. For companies, there is no implication of tax while issuing the phantom share or while giving the value to the employee. However, as it is taxed as income from salary, the companies are required to withhold the taxes, that is TDS to be deducted. Coming to the legal framework, the Companies Act has the framework for ESOP and employee stock option plan, but it is silent about the SAR or phantom share or the hidden shares. So as per the Companies Act, there is no legal provision for specifically for phantom shares. As a procedure, the board can approve the matter and it can be given as per the plan approved by the board. This is all about the phantom share. Thank you very much.